Hello, everybody, and welcome back to this week's Money and Markets Squawk Call, where we go around the horn with our editors to give you their insights on the happenings in global financial markets for this week and beyond. Today is Tuesday. It's May 3rd. I'm Mike Burdick, and joining me today are Mike Larson, David Dukevich, Kathy Lean, and Mandeep Rai. Well, we're in the merry month of May now, and of course the old Wall Street saying is "sell in May and go away." We'll see if that works this year. Of course, we've had a kind of a rocky start to the year, but stocks up altogether. Entering this week, we've seen some pretty negative earnings results from European banks. We've got European stocks down sharply this morning, about 2%. Some negative trade data out of China again. And I guess the real story is what's going on in currency markets with the dollar sliding to the lowest level in a few years. I think since 2013, the yen is soaring, which is of course tanking Japanese stocks. So no shortage of volatility as we enter the month of May. Mike Larson, why don't we get your thoughts on the markets first?
Yeah, thanks. Good morning, everybody. As Mike pointed out, the dollar is really the big story. I mean, I started getting aggressively long the Japanese yen at the beginning of 2016 because it looked like it was bottoming. The yen has always been kind of a risk-off currency when central bank policy starts to backfire, when carry trades, which is just borrowing cheaply and yen, selling the currency and buying assets elsewhere around the world. When those carry trades start blowing up, it's good for the yen and bad for riskier assets like junk bonds and stocks and so on. And that trade is paying off fantastically. The yen just hit an almost 18-month high against the dollar. And basically what's happening is the Bank of Japan is completely failing at everything it's trying to accomplish. Whenever it wants the yen to go down, it goes up. When it wants to spur Japanese investors to buy stocks, they take their money out of banks and put them in safes in their backyard and so on. So basically, betting on the yen rising is a bet on central bank failure, and that's clearly working there. What's happening now is that weakness in the dollar and strength in foreign currencies is spreading to other parts of the world. Sort of my sleeper play, a yen on the cheap play has been the Swiss franc, and the Swiss franc, which is kind of another safety currency. As we speak, the Swiss franc is hitting its highest since September of 2015. So that is starting to move my way as well. And the broad dollar index took out the key 93 level yesterday, and it broke through 92 this morning, although it's trying to bounce a little bit here. Basically, the dollar index, if you look at a weekly chart, is on the cusp of a potential substantial breakdown, that would reverse all of its gains or basically take away all of its gains since the beginning of 2015. And if you look at a chart, the dollar really started to rip in mid-2014, June-July timeframe, and that run started all the way down to 80 and took the dollar index as high as 100. Now we're at about 92. If we break down here, I mean, we could retrace the whole move down to 80, which would be a pretty significant move in terms of currency markets. So definitely worth watching there. The implications for what it means for other markets is kind of mixed. The standard talking head on Wall Street or CNBC who doesn't know any better says, "Oh, dollar's going down, buy stocks." Well, not really. I mean, if the dollar is going down, one of the reasons the dollar is going down, in my opinion, is that the U.S. economy is rolling over. If you look at data on retail sales, durable goods, auto sales, industrial production, consumer confidence, manufacturing, I mean, the data is getting worse, and anybody who denies that is whistling past the graveyard. I wouldn't say the figures are recessionary yet, but they are certainly weakening here in the U.S., which to me suggests that the U.S. is catching this global flu, and that you're also seeing some of these bubbles that we've had in the U.S. start to burst. I mean, IPO funding is drying up, tech unicorn funding is drying up. Just yesterday, the Fed released its latest quarterly bank lending practices lending survey. Now, the Fed's been conducting the survey for years and years, and basically it goes out and they ask banks, are you tightening or loosening standards on a variety of loans, everything from home mortgages to commercial real estate to commercial and industrial loans, which are basically core business loans. They ask, okay, if you are still making those loans, are you charging more for borrowers to get them? Are you seeing more or less demand? Blah, blah, blah. Basically, on the commercial and industrial side, lenders are now tightening loan standards at the fastest rate since the fourth quarter of 2009, which of course was the end of the last, or towards just after the end of the last recession. If you look at commercial real estate loans, they're tightening lending standards across the board at the fastest pace since the first quarter of 2010, 6 years ago. There's now been 3 quarters in a row of net tightening on C&I loans, commercial and industrial loans. That has never, ever happened in the last, 30-odd years history of the survey without prompting recession. So basically, you're betting against economic history, you're betting against the credit cycle, and you're betting against, the entire banking industry tightening standards if you say the economy is not potentially going to see recession or get very close to it. So long story short, the economic fundamentals don't look good in the U.S., and I think that that's a big change from what we've had for the last few years. So if indeed the dollar breaks, a catalyst might be lousy jobs figures. We're going to get the latest jobs data very soon. Maybe it's something else. Maybe the GDP numbers get revised even lower, and when we get a negative print, we had GDP growth of 0.5% in the first quarter as of the advanced reading, which is the weakest in 2 years and definitely a deceleration from the last few quarters. So I'm pretty pessimistic about the U.S. economy, which basically means you want to not be buying cyclical, deep cyclical, and other type names, stock market sectors that need a strong economy. And instead, if you're going to be buying anything, it's going to be high-yielding, safe stocks that have less economic sensitivity. Things like telecoms, utilities, consumer staples. Those are the kinds of names that, as long as they have high WISE ratings, safety, good yields, those are the kinds of names that have been performing very well and should continue to perform well. And once we get over this sort of fantasy land bounce in some of the cyclicals that we've had as a result of China unleashing the biggest debt-fueled speculative bubble in the first quarter ever, basically it was something like 1 trillion yuan worth of financial aid to the markets. Once that fades, then I think, that bounce in the cyclicals is probably going to be over as well. So again, that's kind of, I think this is still a cautious environment. I think the U.S. economic data is a real problem going forward, and I would position myself accordingly.
All right, Mike, thanks. Indeed,
Thank you.
Good advice, since we have seen, indeed, the lower volatility and higher quality stocks perform better than the S&P overall this year. Let's see, Kathy Lane, I think I saw you on the call here. At the top of the call, Mike and I were discussing the big story being the volatility we've seen in currencies, with the dollar index actually dropping to the lowest level in a few years and the yen surging higher. What's your take on the movements in global currencies?
So yes, Mike is right. The dollar's on the move, and we've been long euros and taking off part of our position into this move, and they consider taking off the other part shortly thereafter. But one thing I just want to be a little wary of is, obviously every year is very different, but May tends to be a terrible month for a lot of currencies and a really great month for the U.S. dollar. I mean, we took a look, seasonality, take it for what it's worth, but in the past 10 years, we've seen the dollar index rise in the month of May every single year except for 2009 and 2006. And in 2006, the losses were nominal. So I think, that's something important, because for the euro specifically, it tends to be a terrible month. It also tends to be a terrible month for the British pound. So in the context of these, strongly exaggerated moves that we've already seen in currencies, I would be a little cautious. I mean, that's part of the reason why we've taken profits on our euro trade. And I think that, if these moves get a little bit more overstretched, we've got our orders out to sell euro yen because we think that we could indeed get a correction. And I think, thinking about, I still like the short dollar story, but I think thinking about it maybe not as a pure dollar play, but maybe as a cross with the dollar-yen component of it could be something to consider. Now, a lot of people may wonder, what could actually cause the dollar to bottom? Of course, it's not much. And, Mike was absolutely right in that sense that the U.S. economy is doing terrible. And I have zero confidence that even if we get a good jobs number on Friday, that it's going to reignite the rally in the U.S. dollar. But at the same time, we've got a G7 meeting in Japan this month, and maybe G7 policymakers or leaders will have enough political will to provide some sort of coordinated action or coordinated message that could potentially turn some of these currencies around, because everyone realizes that monetary policy just isn't doing it, and fiscal policy really needs to pick up the slack. So the bottom line is, in the big grand scheme of things, we think that the U.S. dollar is still headed lower. But I think at least for the next month, it may struggle, and especially after the exaggerated moves. And for the most part, everyone's priced in no action by the Fed in June. So we may start to get a little bit of a recovery, and we're already seeing that against the commodity currencies today. The Australian dollar is down almost 2% after the Reserve Bank, the only Reserve Bank of Australia, the only central bank that has the guts to do anything, lowered interest rates overnight. The New Zealand dollar is following suit. The Canadian dollar is starting to bottom a little bit. So we're starting to see the rotation in commodity currencies. The euro, sterling, Swiss franc haven't really moved all that, or the yen haven't really moved all that much. But I think that being selective will be important, and that's part of the reason why we're probably going to be putting out a short Aussie cross trade later today, because we believe that you will see the dollar bounce against certain currencies. It won't be a broad-based dollar recovery, but you may be able to play it better in some of the currency crosses.
All right, thanks, Kathy. Very interesting. We'll watch for any fireworks that come out of that G7 meeting. Interesting. Mandeep Rai, why don't we get your take on the markets right now?
Hey, good morning, Mike. Good morning, everybody. So there's a lot that's going on in the markets. There's more and more talk about some type of low probability one-time event that could rattle the markets. Type of a black swan type of deal. And we're kind of ripe. It's reasonable to talk about that kind of stuff because we're ripe for that, something like that to happen. We're within a few percentage points of a all-time new high. The Dow did break out to new high earlier a few days ago, and we have a lot of headwinds. We have 4 quarters of consecutive declines. We're pricey in terms of valuation. Expectations are really, really low. Much of the world is grappling with slow or no growth, and a lot of these economies are over-indebted. They're raising debt. So that's a very bad combination. Take a look at Puerto Rico. And now our old friend Greece is back in the news. There was news over the weekend that negotiations with creditors you're running into trouble again, and it's going to set up potentially another showdown sometime this summer. But we're still grappling for any kind of positive news these days in the markets, and we're still kind of grinding out. It's effectively trying to look further in the future to prop up the markets today, and it's not unreasonable given that interest rates are so low and that we have a very low discount rate, and bond alternatives are yielding very low amounts of rates, and some corporate debts even at zero. You saw Unilever issued debt last week at an effective rate of 0.08%, and that's the kind of environment that we're living in. When companies can take out debt at really low cost of financing, guess what? That debt is going to either speculative behavior. You take bets because you got very low discount rate, or you're going to go ahead and buy back shares. You're going to raise your dividend. You're going to pass on that debt back to shareholders, and you're going to do financial engineering, and you're going to prop up your earnings. You're not going to grow on your top line, but you're going to engineer bottom line growth by buying back shares, and you're going to reward your investors by saying, hey, we have year-over-year growth in earnings. But it's a game. It's really just smoke and mirrors, really, because you're not really operationally, growing. The underlying business that the shareholders are buying may be failing, but it looks like it's actually growing. So, the market is still susceptible to large swings because of those types of things. Even the volatility just started picking up in the last couple of days. The fact is that after we fell 11% in the first 6 weeks of the year, the next 6 weeks we gained 11%. So we got it all back. That's pretty impressive. But then in the next 5.5 weeks, we've only managed to eke out a gain of about 1.4%. So things have slowed down considerably, and we were touching that resistance level in the S&P 500 and other indexes. And you're kind of wondering if we can break out to a new high. So, the question that you asked at the beginning of the call is should we sell in May and go away, as the old adage says? And I would say so. My portfolio is ultra conservative. I've used this rally to raise cash. I've taken profits and trimmed down long exposure. But I've been kind of eyeing more speculative stock-specific stories to add to the portfolio, and those I do with risk parameters in place, and I'm kind of in stocks that are agnostic of what the market conditions are, those that have little correlations to the overall market. And we already know that the earnings story this quarter is pretty bad. Right now we've got 70% of companies, and the average decline is 8.8%. The interesting thing is the average beat is by 4%, so that just tells you what the expectations were. Energy, as we know, is not a surprise in terms of being the biggest loser. Materials and financials closely behind as well. But then we also have, surprisingly, tech down 8.3%. And that's one of the higher growth sectors in the overall S&P 500 and the overall market, and that's thanks to the likes of Apple, Microsoft, and other large cap tech companies that are starting to show signs of growth. And Mike Larson mentioned as well the IPO market, and it's really interesting because the valuations in the non-public world of in tech. These so-called unicorns that have a valuation of $1 billion or more are starting to decline. And there's 88 companies that are in that unicorn universe, and 9 of them have changed CEOs in the last couple of months, and some of them have experienced layoffs. What's more interesting is that these companies are trying to use the frothy situations, the higher multiples that they get on their businesses, and they're trying to raise more capital, and not because they need it, it's just because they can, and it kind of tells you they're just trying to use their valuations as ATMs, and they can do it, but in some cases, what they're just trying to do is, keep alive some dying parts of their businesses. So that's kind of concerning, and you want to watch some of the larger ones. Uber, which is kind of one of the king unicorns, if you will, $62.5 billion private valuation. If that business starts to show cracks, that could have accelerated implications, negative implications for all startups and even potentially public markets as well. So that's the kind of stuff that we're looking at. Financial engineering, is going on, as we said, in the rest of the market. Investors are kind of looking for growth, and they're getting it through that engineering rather than anything else. What in the last GDP report, for context, fixed non-residential investment dropped by 5.9%. So that's not indicating that companies are feeling good about investing in the future. The growth is not there. The opportunity isn't there. And so that's concerning about the future. When you have over-levered companies, economies, and so forth, you need to have some type of growth to sustain those debt payments. The hurdle rate is much lower because the discount rate is lower, but you do need to see something. So it's kind of setting us up to be more cautious. And I don't think that we're going to have a huge bubble that's going to burst. But these types of cracks and the market kind of rallying despite that, it leaves me concerned.
Yeah, indeed, we have seen a surprising lack of organic growth with top-line sales for the S&P down 5 quarters in a row, as you pointed out. So we'll see if that is going to turn higher. Let's see, David Dukevich, let's get your views. We've seen certainly some interesting movements in the commodity market, kind of counter-trending to what's going on with the dollar. Gold above $1,300 an ounce to start this week. What's your take on the direction for commodities going forward?
Hey, Mike. Hey, everyone. Yeah, you're right. Gold, last Friday really took off, stopped just below the 1,300 mark, but then yesterday it did follow through and get as high as 1306 in the morning. It pulled back in. Right now it's trading right around that 1,300 mark right now. And really, once we broke that previous high we set earlier in the year of 1287.80, that really kind of finally broke us out of the trading range we had been in for about a couple months. So that's really a key level to see now if we can hold above that. And if we can hold above that and then get, above on a closing basis, above maybe 1302 to 1307, somewhere in that range, and really start to see some momentum, we could see gold push even a little bit higher. potentially getting as high as maybe 1343, 1344, which was about where the 2014 high was. So those are levels to watch there. But right now, as we mentioned, I know Kat, we mentioned it early on the call, this tends to be a fairly strong month for the dollar. So if we do see that happening, we could see that this was maybe just a false move on a breakout, and we will see gold pull back into that range and maybe even test the bottom part of that range and get back down into that 1220, 1207 range. So it's that 1287 mark is really a key level to watch right now on any pullback. If gold can hold there, it may be able to push higher. But if it doesn't, we could see that this move really wasn't much of anything but a head fake. So that's really a key level to watch. With oil, we've seen it break up, getting over $46 a barrel. It's trading just under $45 a barrel right now. We could see a pullback go a little bit further and even see it drop maybe to the $43, $42 range. If it does hold within that level, we could see it continue to push higher and get to that $48, $50 level. So that's something to watch on oil. The dollar could also play a factor in there as well. So it's something to watch. Natural gas hasn't broken down any further, but also really hasn't been able to break out of its downtrend as well. It's kind of been sitting down in its own range. It's gotten up to the high side of its range. It really hasn't broken down below $2 again recently. So if it can hold there, we should see that push higher again and maybe try to get back to the 225 level, maybe even try to press the 250 level on the high side. You guys have been talking about the markets. The S&P really has had a hard time getting above 2100. It's every time it has, it's failed. So we've kind of seen ourselves now bounce around. Every time it gets up there, it pulls back, but it really hasn't all broken down at that same sense. So it's key to see if we can maybe break below 2050, maybe get down to 2015. If it breaks there, we might be able to see it break down to the 1950 level. But if it holds, it could continue to keep trying to press that 2100 level. If it gets above there, then I think we will try to test a new high on like the 2135 level.
Okay, thanks, David. Interesting trends to keep an eye on. Well, that wraps things up for this week's Squawk Call. Great insights, ladies and gentlemen. Thank you one and all. And be sure to tune in again next week. Until then, I'm Mike Burnick for Money and Markets. Good investing.